All right, so let's begin. And today we'll be talking about retirement planning. We have various investment instruments where one can invest for the purpose of retirement. But then today we're going to talk about specifically retirement mutual funds. And for that, our focus or the fund in focus today is Access Retirement Savings Conservative Plan. And to talk more on this, I have R. Sivakumar, Head Fixed Income Access Mutual Fund. Hi, good evening, Mr. Sivakumar. And we'll be talking about the retirement fund, which is Access Retirement Saving Conservative Plan. So before we get into the nitty-gritties of this fund, I really want to understand the entire concept of having separate retirement-based mutual funds. How different are these funds from a regular mutual fund that your AMC has to offer?
First of all, thank you for having me on. Yes, I think it's a very good question to understand what makes this fund different from others. To be honest, the investments that we make are largely in the same kind of instruments, equities, fixed income, and therefore one might think that it's just another mutual fund. But I think the important thing is two parts. One, from an investor perspective, these funds come in with specific features. In our case, for example, a minimum 5 years holding period. Money is locked in for 5 years at the minimum or until the age of 58. And from the investor perspective, while this is lock-in, but from the fund manager perspective, it really gives a longer runway or visibility of the corpus of the stability, and therefore the fund is able to take a much longer horizon view when it makes its investment decisions. And I think this is a crucial factor when you're designing these so-called solution-oriented funds, that they have specific characteristics which help or guide both the investors and the fund managers to make much more, shall we say, longer-term investment decisions rather than more tactical in nature. I hope that addresses the crucial difference between a solution-oriented fund and a normal open-ended mutual fund.
All right, so I think solution-oriented investment is going to be the big theme going ahead also, which, as investors are also understanding the entire purpose and the way towards they can plan their financial planning. So solution-oriented products are going to be quite in trend. But then just talking about this fund, a very basic question, I really want to understand, because it's a retirement fund, what's the kind of allocation across asset class this fund has?
Right. So what we have done is, actually this fund is part of a family of 3 funds. So there is an aggressive plan, which has a higher allocation to equity. This is a conservative plan, which has 20 to 40% allocation to equity. So relatively smaller, but significant equity allocation. And then there's a dynamic plan, which kind of allocates equity and fixed income on a dynamic asset allocation basis. In a conservative plan, what we're trying to do is to have more of a bias towards debt than to equity. This is therefore suitable for someone who is closer to retirement age than someone who is early in the savings part of your career. And therefore, as you get older, you will need to de-risk your portfolio. So the objective here is that while you get closer to your retirement, either you switch into this fund or you increase your allocation into a fund like this, which then reduces the risk of your portfolio as you get closer to retirement. So when you look at solution-oriented funds, very often you find these packaged in this manner so that you get different risk profiles within the same fund family. And with a conservative plan, the idea is to have a relatively low risk as you get closer to your own retirement age.
All right. So as explained by you, equity is almost 39.5%, debt securities 49.9%, out of which corporate bond is 23.9%, and cash and others is almost 10.4%. Now, see, it's a conservative plan, so it's very important for an investor to understand that there is a time where you need to start investing in funds like these. Okay, just to set an example over here, or maybe you could explain better. An investor has a portfolio of different kind of mutual funds. What and when exactly do you think one should be investing in a fund like this for the purpose of retirement specifically? Now, this is a conservative plan. Do you think closer to the retirement, investing closer to the retirement would definitely make sense to them, because being a conservative plan, they might just not want to take risk with the entire corpus that they might have accumulated by investing in different investment instruments. So how can an investor time an entry in this particular fund?
Look at your retirement savings in 2 phases, right? The accumulation phase and then your eventual retirement phase. So when you look at your accumulation phase, you want actually higher returns and therefore higher allocation to equity. You have the ability to take risk because you have your regular income from which you're making these savings. But when you get closer to your retirement or in retirement, you obviously want to de-risk your portfolio as you are largely relying on your retirement corpus to live on. And therefore, you will want to de-risk your portfolio as you get closer to retirement age. Now, there's a typical rule of thumb which used to say that your equity allocation should be approximately 100 minus your age. So that means when you're 20 years old, you should have 80% equity. But also what that means is if you're 60 years old, you should be closer to 40% equity, which is kind of where this fund is, right? So this fund is really suitable for someone who is actually getting closer to the retirement age, where the asset allocation of this fund more aligns with this classic idea of 100 minus age to someone who has already made an accumulation and now wants to kind of perhaps decumulate, that is to say, make withdrawals to live on. I think that's what this is suitable for. I'll also make another important point here, which is that while we think of retirement savings as for ourselves, realistically, you have to look at retirement savings also as a means to build wealth because you're leaving it as a legacy, you're leaving it to your heirs. So retirement planning constitutes two parts, for yourself and for your family. So I think you can't have a situation where even in retirement you're at zero equity. You need to have reasonable allocation to equity and reasonable allocation to fixed income. So that's the way we've looked at it. We've looked at it from a perspective, can this fund give a mix of both income as well as growth? And we think an allocation of about 60-40, 60% to equity, 40%, close to 40% in fixed income, 60% in fixed income and 40% in equity, I think gives a good mix to the investors looking for that kind of risk profile.
All right. Now let's assume an investor invested in a fund like this for a decent amount of time, this fund could also be a part of their accumulation phase. Talking about using the amount for their retired life. Now, how can that be processed or initiated through a fund like this? Could you please elaborate on that?
I think this is again something where people don't really use mutual funds now. One of the things that mutual funds are really good at is managing your taxes when you withdraw. So, for example, we are all familiar with the SIP or the SIP, where you invest on a monthly basis or on an installment basis and building up your corpus. Much the same way, you can also withdraw using what's called a systematic withdrawal plan, SWP, where you withdraw whatever you need on a monthly basis. The beauty of this is that because you're redeeming in fractions, your tax liability is only to the extent of the unit rate. And this fund falls in that greater than 35% equity basket, which means it gets debt with indexation benefit, right? So therefore, there is indexation benefit or long-term capital gains tax benefit to an investment like this. So you can defer your tax because you are only paying tax to the extent of the units redeemed, but also you're getting indexation benefits, which significantly lowers your tax liability. Lastly, of course, your tax liability, even if you were to look at it from a short-term capital gains tax perspective, is likely to be lower in retirement than it is when you're earning. So for all of these reasons, it's useful to look at these kind of products. In general, any mutual fund product, but specifically these kind of retirement conservative plan kind of products, to look at managing your post-tax rates of return once you are in your accumulation or your withdrawal stage of retirement.
A fund like this can be a better option than investing in a fixed deposit, given the current interest rate scenario. Do you think that's the right comparison?
I think the way we manage this portfolio is we have got an active debt component and an active equity component. The active debt component is running a sort of medium to longish strategy about duration of a little over 4 years. So that kind of gives you a range of the kind of volatility that you expect on the debt side. It's a 4-year duration. It's not a very long duration fund. As I said, the average maturity, for it's a little over 6 years, which is in line with that expectation of 5 years plus holding period that we expect investors to have at any point of time. And if you look at the equities, again, managed with a longer term. Now, given that there is some equity in this, remember that you can't make any prediction about the expected rate of return in the short order, meaning next 1 year, markets could go up and down. But if you look at a 5-year, 10-year perspective, the expectation is that the equity should be able to give you some kind of outperformance over fixed income. And this is a historic cycles, right? So the objective for us would be to manage both parts with a kind of long-term focus and the ability to outperform classic savings instruments. And we can do that. And like I said, bring in long-term capital gains tax. I think post-tax rates of return can be quite attractive in the product.
All right. Now, talking about a conservative strategy like your fund, to balance it out, how can one plan their financial portfolio? Maybe if someone is getting closer to their retirement and it's time for them to, maybe just go easy on equity and have more allocation on fixed income or maybe safe assets, how can you balance out your overall strategy when it comes to, being placed in fixed income when you're closer to retirement?
And again, a very good question. And I think you can't have one fund which plays it all for you. So you have to have a strategy where you look at your overall asset allocation. The number one thing that determines returns, total returns over a period of time is your asset allocation strategy. So I think you need to have a good mix of different asset classes. Now, obviously, as investors or as householders, as people working and living, we already have certain assets which we would have built over our life cycle. So you may have a house, or you may have other fixed and physical assets, gold, etc. And when it comes to market-linked assets such as bonds and equities, that's where a funds like these or other funds. So a fund like this, which is a 60-40 mix between debt and equity, may not necessarily be exactly suitable for any investor. So what we always tell investors is to please have a financial plan in mind. Make sure that you have a total representation of your portfolio across debt and equity and across the different funds that you have. And so please speak to your financial advisors, please speak to a planners who can help you make an asset allocation plan. A fund like this is one hopefully important cog in that whole architecture.
All right, Mr. Sivakumar, thank you so much for being on the show today and decoding all the facts about Axis Retirement Savings Conservative Plan for our viewers today. Thank you.
Thank you.
All right, so that is a safer option for your investment as far as your retirement planning is concerned. But then time to slip into a quick break. Post that, let's talk about a risky investment. And by that, I mean a micro cap exposure in your portfolio via mutual funds. So what's the buzz about micro cap that's going on, and how can you place it in your portfolio, with what kind of exposure, and what's the right route to have micro caps in your portfolio? All of this with Arnab Pandya after this break.